Hi there everyone and welcome to our very first Between the Lines live webinar. My name's Vanessa Rader, I'm the Head of Research for Ray White, and I'm joined today by a panel to talk about the future of commercial property and also some things that are happening in the market at the moment in terms of financing and what the outlook is for the way ahead. So I'm joined today by Peter Vines. Peter Vines is our Managing Director of Ray White Commercial Western Sydney, and also Stephen Bajukas. Stephen is the Executive Director at White & Partners, so welcome guys.
Thank you.
Interesting times in the market at the moment. Let's start looking really high level. So there's a lot of indicators that everyone's looking at and wondering how that's going to impact the market going forward. So we've got record low unemployment. We're all saying there's a skills shortage. We've got migration tap just about to be turned back on, so population is really going to increase. Yeah. But we have inflation really high, and as a result, we've got interest rates that are growing. Interest rates are tipped to continue to grow throughout this year, and that's having an impact, obviously, on all sectors of the market, including commercial. Yep. So I'll start with you, Pete. Can you tell us a little bit about what you're seeing currently in the market? We know that the last year we saw an awful lot of transactional activity. It's starting to slow a little bit now, but what are you seeing in the market?
Yeah. There is a lack of skills out there, so if anybody wants a job, look, I think it's very much. I think whenever there's major changes in the market, it's a just wait and see. I think particularly at the moment, there's a real sort of divide between where vendors might have been and where purchasers are. I think that froth has come out of the market, and that fear of missing out.
Yeah, definitely.
Which is obviously, I mean, there's a whole lot of things that are compounding that. Tenants that might not be as stable in the current market, office, which is an asset class which we'll talk about a little bit later, development, which is but I think that people are just being a bit cautious. So unless there's a story behind it, it's really the professional investors who we're seeing out there at the moment who have sort of been waiting for the market to change a little bit.
Yeah,
is really what we're seeing.
Yeah. Okay. Anything to add to that, Steve?
Look, I think Pete's right. I agree. We sort of wear multiple hats where we can play as lender or we can play as property owner or developer. And I think from the equity perspective, I think we're sort of waiting to sort of see how things go and wait for opportunities to come up.
Yeah.
It'd have to be a compelling story.
At this current time, yeah, I think so. But I think the opportunities will come up.
Yeah, well, it's interesting you say about the that kind of wait and see attitude, because a lot of the stuff we were writing, particularly when COVID first started, was a lot of both vendors and purchasers were just kind of sitting and waiting to see what was going on. So it kind of feels like that kind of is back in the marketplace now. So let's look at a few specific asset classes. So you mentioned office. What are your thoughts on the office market? Vacancies are still pretty high, improving in some markets, but still pretty high across the country. Work from home is still an issue people are trying to deal with. Incentives are still there, but we still have inflation quite high. What's your thoughts on the office market going ahead? And
look, it's a big question. It's probably quite a political question. Look, I believe in office. I think that the office that we have, I think everybody will be sort of looking at the way they use office differently, and when they have surge times, and we have to adapt. I mean, retail's become very good at adapting to situations and who their tenants are over the years, and I believe commercial will do a similar type thing. There's speaking with some of the major investors and developers out there are still tenants who are active in the market, and so I think it's more, what do these tenants now want? How do we give that to them? But certainly, these spaces, whether people are going to contract, obviously there is contraction, but also I think we'll see more meeting rooms, more call rooms, that type of space, filling up the space of other people where they were sitting previously.
Yeah.
But I think working from home is a real thing. Like it or not, I think certain industries it probably suits them. I think there's a whole lot of skills and learning that people will miss out on because of the fact that they're not in the office, they're not hearing, they're not having these conversations. I think there's productivity which gets lost, but also, on the flip side, there's also, you're not travelling as much. So you get to concentrate more. It might be a quieter environment. So again, I think it's, horses for courses, but I think there's probably still a lot of people sitting on their hands, with office at the moment.
So taking that a step further, so we're seeing some yield kind of moderation is probably the nice way to say it, where things are just, because people are just waiting and seeing what's going on. Any further thoughts on what will happen for office? It's just like any other asset class, will depend very much on the tenant profile and the size of asset, and just a wait and see for what's going to happen with yields there.
Yeah, I think so. I mean, it's sort of, with the cost of capital coming up, I don't see any movement except for up
Yeah.
in terms of yield. I think it's more of a when will they stabilise and what's the new norm? And I don't think we're at that level yet because we haven't really had that period to digest the increase in capital. But I mean, certainly, there's a lot of money invested in it.
Yeah, well,
so,
given you're speaking
yeah.
about that, I think we'll speak to Steve about some of the alternative kind of financing options that have been out there, particularly in the last couple of years. We've seen the banks coming to the party in terms of lending, but we've seen all these alternative investment options out there as well. When the market starts to move like this, is that a time that you see those players retreat from the market, or what's your thoughts on what's going to happen with financing going forward?
Yeah, look, I think there's still a lot of money out there, and the alternative lenders, I think that space is only continuing to mature. And I think the last 12 months is where borrowers actually said, you know what, I'm comfortable going to a non-bank lender. They're not the scary people that they thought they were. The banks are still there, absolutely, they're still lending, but I think the non-banks are giving a real spectrum of products for property investors and developers to actually buy and develop property. And they're competitive, they're very flexible, and it's readily available. There's plenty of it. So, we are one of those players in the market, and our book has grown exponentially. And I think it's a structural shift that's happened where the banks will still always be there, but I think there is a mature sector where you can get alternative finance from.
I think the word flexibility that you said there is probably the key part. So you're seeing people come to you because you do offer that flexibility. While it might be slightly more expensive, there is, that need or want for that flexibility, in terms.
Yeah, no, absolutely. I think it's whether it's particularly speed to market is quite important for borrowers, particularly when, as you know, good property, good opportunities, you need to act fast. And so if you don't have a capital provider, whether that's senior debt, MES or a joint venture partner, I think speed is critical to it.
And does that extend to construction type loans as well?
Absolutely. So there's, it's not just local non-bank lenders. There's the international. We work with a lot of US, Canadian pension funds, Singaporean pension funds. They're all here and they're all active at the moment. And they think for example, the residential development market is the supply and demand thematics make sense. And yeah, it is available. I think developers need to be realistic with the cost of that funds. It is going up, but if they want the speed and the availability of that capital, it is there.
Yeah, okay. And so,
There's
Pete,
a place for it, yeah.
with the deals that you're doing, are you seeing a lot more of these lenders? Like what kind of proportion? Do you think is that's happening more than ever before?
Well, in development, I reckon they're probably 70, 80% of the market. I mean, particularly in Western Sydney, they're hugely active.
Yeah, okay.
And they're flexible, and there's that speed of and they're also willing to take risk. Yeah. Which sometimes when you do development, you need to take some risk, and so they've been there supporting certain developers who can do good quality build. And who deliver product and who have a good name in the market. And so I like Steve think that will just continue. Yeah.
You mentioned retail assets before, and you're right. They're probably one of the assets that they've had a really hard time in terms of all the online trading, but they've been able to adapt. You're seeing more and more, particularly in centres, kind of more medical assets in their childcare, reusing some of that space to something else. Yeah. There's some co-working sort of arrangements in some of the retails. Do you have a thought on retail? You do a lot of stuff in your local area. Yeah. Retail market's a bit tough.
We do bits and pieces. So we don't particularly sell large shopping centres. We do strip retail. Occasionally we'll sell something with retail and land, etc. But look, I think there's some people who understand that market exceptionally well, who still see an opportunity. But I mean, it's like fashion. Fast fashion's difficult. It's gone online, so it's very much, I think, moved more to a experimental, or if that's the right word.
Probably services. A lot of services and kind of experience.
Food and beverage. I mean, that's what people want.
Yeah,
you have to have a reason to go there. I don't know what it is because I don't want to go, but no. I'm very comfortable shopping online, which is obviously why industrial's done so well.
Yeah.
Not because I'm buying new suits. But I think there is still a huge place for retail, particularly convenience-based retail.
Yeah.
But maybe the footprint of retail starts to shrink. And then it's sort of, there's multiple uses like your childcare, like your service amenity, maybe aged care and other uses on a site in the future.
Yeah, well, because they're always
benefit from that land holding.
And also they're usually very well located. They've got parking, public transport nodes and stuff. So there is a big opportunity for those kind of retail centres.
Sure,
but you mentioned industrial, and I think industrial's been the golden child for the last little bit.
Yeah.
We've seen yields get down to levels that, like, I certainly didn't expect to see, and I've been doing this for a little while. The demand for stock has been huge, and it's not just the transport and logistic users and storage because of that kind of online retailing piece, but also the small industrial units, the small industrial units.
Huge.
There's really local new businesses emerging, people buying their own owner-occupiers, looking to shelter from possible increases in rents, but also just to, people buying their self-managed super funds. We're seeing a lot of that happening. So what do you think is going to happen? We're at this point now where the interest rate, not the interest rates, but the yields are so low and interest rates are going up. But vacancy is so low for industrial, like it's so low. So what's your thoughts on where we're going to get at with that?
Well, I mean, speaking to the industrial agents and also, the industrial investors, they're all waiting. I mean, rental growth, particularly in, those inner ring suburbs, has already, gone through the roof.
Yes.
And there's, people who are in premises who are looking to sublease and, making more money than they were when they were actually, just doing direct lease. So I think there's enormous pressure on those areas at the moment. I think, I don't think yields can stay where they are because as the cost of capital comes up, it softens.
Yes.
But, I think there has been a fundamental shift away from potentially certain, retail or whatever it might be. And I think, industrial is one of those major, particularly with, we don't just want, to buy things online. We want it quickly.
Yes.
We want it really quickly. And if I have to wait 3 days for something or 5 days, I'm like sort of starting to get a bit like itchy. Absolutely.
Well, that's why a lot of those infill suburbs have done quite well because they've been able to capitalise on otherwise vacant assets that were good for that last mile piece to make sure that we could get that rapid kind of delivery, which is what everyone's craving for. Do you have a thoughts on
dark storage for the supermarkets and that kind of thing is a massive thing. They
dark
need
kitchens. I've just talked about
dark kitchens. Yes, not cookie in the dark. But yeah, I mean all of those things.
Yeah, and development is a bit tough at the moment. Like there's not an awful lot of vacant industrial land supply. It's expensive to build, but yeah, there is the demand out there. It's just
and I think that's obviously what's going to keep pushing rents as well. Is that there's not that availability of stock. I mean, you cannot go out and find a 10,000 square metre shed in Western Sydney at the moment. They're not there, and so. The supply, while there is land out there, some of it's not serviced, some of it's not zoned, but trying to get it out of the ground, particularly with where land prices are and were with build costs and yields, I think that's why the story around rental growth is really, a positive one.
Definitely for the industrial market, that's one where you can say that inflation's helped that kind of move up, and there is huge growth in rents there, and that's why we saw a lot of those owner-occupiers jumping into the market just to shelter themselves from what was going to come.
I think a lot of those people are sitting on the fence a little bit.
Yeah,
they might just be sort of just waiting to see kind of what happens.
Yeah, it's an interesting time. We talked about the rising cost of building costs. Is there anything that you want to add to that, Steve?
Look, we stay close to a few builders, just understand what's happening in the market, and so the feedback to date is that construction costs are unlikely to abate. They'll continue to rise, probably at a slower pace, and they'll probably settle down sometime first quarter next year, and they'll probably just sort of stay stable. All the builders we're speaking to, they really want some good news on some cost pressure relief, but it doesn't look like it's going to come. So I think developers and financiers, for that matter, need to be cognizant that construction costs are expensive and they're probably going to stay expensive.
Yeah, it's an interesting time for building costs and what's going to happen with the development market going forward.
Absolutely.
Yeah.
I think we're all very bullish though about development sort of after things sort of calm down a bit, because there will be a huge amount of pressure
Yes.
on particularly residential.
Yes.
You know,
Well, we just said that the migration's going to turn back on.
Yeah.
Vacancies for residential properties the lowest it's ever
talk
been.
about rents going up,
rents going up.
massive,
That kind of has to
Yeah,
happen.
and that divide, I mean, we talk about a lot, is the divide between, housing prices and apartment prices, and it's just, the gap is enormous.
Yeah.
And so as people's buying power goes back, I think, the apartments and that immigration coming in will just, we're expecting quite a big uplift, particularly in demand for residential apartments, sort of in that 12 to 18 months.
Absolutely.
Yeah. Yeah, so we were talking about rents before, and so yes, we've seen the huge uplift in rents for industrial. Office, not so much. One of the things that we just to jump back to office for a second, is I was speaking to one of your colleagues actually the other day and talking about how people are inquiring on office space, but with the working from home, people aren't looking for as big spaces as they were before. They were not looking for huge amounts of space to grow into. They're looking for the stock that they need right today and now, not necessarily factoring in growth. Again, work from home, being able to do some of that. Have you heard any of that, or is incentives still playing a big role in people's decision to, like, people are obviously flight to quality, people are going to those better quality assets, they've got incentives in them. Yeah.
Look, I think it's a great time to be a tenant. I mean, look, it's being a tenant though, and looking at space at the moment is a little bit like being an investor. You don't quite know what to do. Okay, and so I think the easiest thing is to do nothing. So unless you've got like a need to do something, you're unlikely to. Having said that, I think it's a great time to go out and get a good deal, particularly if in certain circumstances where there's very good space available, there might be fit outs available. It's not a bad time as a tenant to go and reposition yourself in one of these newer
Higher
buildings.
quality buildings.
I think that flight to quality.
Yeah, we can see that with all the
likely
vacancy numbers. Like, vacancies still, it is coming down, albeit slowly, in that premium and A-grade space. But yeah, it's interesting. So that's office, industrial, retail. What about some of those alternative asset classes? Like I write lots about those. I like the childcare and service stations and all those things. And medical as well. We talked about industrial, but there's cold storage, and medical kind of falls into that category to some extent. So you're doing a lot of financing in that sort of area. Steve, anything to talk about?
Further to what we're talking about with industrial yields being so low, I think investors and lenders are looking for things that have got a little bit more cash flow yield. So we've been active, as you know, in the childcare centre. So we think that given all the government subsidies and backing on it, it makes a lot of sense, particularly in a in a downturn in the economy. We've also been pretty active in the pub and hospitality space. And that space has gotten quite active. There's a deep market of buyers and sellers, and financiers always like that. So, I think those alternative assets, they're pretty attractive to investors given where things like yields are on industrial, the uncertainty around office and retail. So,
how about aged care? Aged care?
Look, aged care again, I think that's another one where it's got a lot of government subsidies. We've obviously got an ageing population, and there hasn't been a lot of quality aged care product being developed, particularly in sort of Sydney metropolitan area. It's very difficult, and they're all full.
Very difficult. Yeah, it is. I think that there's a lot of old stock, and I think there'll be a reconcentration of providers out there, and there's a lot of issues with the fund. Well, sorry, I'm told that there are issues with the current funding model from a government subsidy perspective, that is, as opposed to a private funding model, which is just making it more difficult to provide that care with the number of people that you need, the number of hours they're able to work, and so I think there's going to be a fair bit of change in that space. Independent living units over 55s has been very strong in the last 12 months, and I think will continue to be strong as well.
So again, we've seen the yield compression in the assets like childcare. Like it's just a matter of with interest rates going up, the cost of funding, that's just going to have to...
It's just a, that's just part of,
Yeah.
things become more expensive, you need a higher return.
How are you going with inquiry level? Because obviously these assets were flying out the door, that we were turning them into set and forget assets, the childcare centres, like I said, the service stations, long-term secure income stream, very attractive to investors when it was cheap finance. So are those investors still in the market? Is there just the more sophisticated ones left? Who's inquiring on these assets?
And so there's obviously so many different kinds. We've gone through a number of them. Look, the pure passive investments, there are still people out there. There's no doubt. There's still a lot of people out there with a lot of money. It's more, I think they're just sort of waiting to see where things end up. There are a lot of what I would call the sophisticated investors out there who have been waiting for a slowdown, and who see right now as a very good opportunity to buy. And I kind of agree with them, because whenever there's fewer people in the market, it's quite a good time to be in there, because there will be opportunities that come up. Value add is a space that I think is really a very good one at the moment. You have that ability to buy in at a certain price and add value to it. So I think those sorts of opportunities will continue to be strong. We're still getting very good inquiry. Owner-occupier stuff is still good, but land is slightly more difficult. There's fewer inquiries. The owner-occupier market has just sort of slowed down for the minute, and I fundamentally believe that these things will only be temporary. I think as soon as the interest rates hit a level where there's stability, the market resets and goes again. Depending on what the economy is like, obviously, but people just want visibility. What causes instability is when people can't see the future as well. And so I think once they've reset, they'll kind of go again, quite quickly afterwards.
And I think that opportunity window is actually going to be quite short. I think everyone knows where interest rates are anticipated to go. The Reserve Bank's starting to provide that transparency. The market's pricing in what the interest rates are going to be for the next 2-3 years. There's even sort of talk of interest rate cuts in 2024. So I think that opportunity window, Peter, as you're saying, I think that's shrinking, and I think the opportunities now's the time to start transacting.
I completely agree.
Well, that was my next question, was going to be, what are the opportunities? We're a challenging market now. You've probably mentioned a few of them, but where do you see kind of the land and the upside and things like that? Is there anywhere that you can pick, or an asset class, or what you would be looking for, an opportunity going forward?
I'll go first before Pete takes my ideas. I actually think I'm bearish on some sectors, but I think I'm actually pretty bullish on residential apartments, as we sort of touched on. I think there's unfortunately some developers that have probably paid too much for land prices and where construction costs are going, and if they've got expensive debt on the land,
got them as well.
I think there'll be developers that will look at their site at the moment and say, look, it's not feasible, I need to move it on. And I think that's where I think opportunity would be for astute developers to actually find a site, buy it at a good rate that makes sense today where construction costs and where interest rates are, and take advantage of where I think there'll be an undersupply of apartments.
I think land is where the opportunity will be. I mean, particularly if you're sitting on cash, I think there's an opportunity at the moment to, there will be shortly to buy sites. It's still very tight, but that's where I sort of see the opportunity. And I also, it's always, I like to look at what people don't like to look at. So, B, C grade office and that type of thing. If other people don't want to buy it, I think there's a good opportunity there, because there's fewer people in that space. There's a lot of talk about it. But there's an opportunity in everything. But I think you're more likely to get potentially favourable terms on things at the moment. If you can hold people's value, you might get things that de-risk projects for you. So I think it's all about terms and timing. So if you can push the project down the road, that's where the opportunity is. So you're buying today, but the opportunity is actually further down the road. I think that's where you want.
So vacant assets with upside.
Got to come and see Steve to fund them, but please. I like vacant assets because they're more difficult. there's fewer people, competing on them, and so that's where the opportunity comes in to create value. I mean, if you just want a passive asset, then it's a good time to buy passive assets as well because there's fewer people, so your return will probably be better. But I like the ones that are sort of, more problematic.
Yeah.
That's where you can create the value.
Oh, 100%. And so at the moment, those sort of assets, you're generating interest from kind of your really experienced investors. These aren't your first timers coming in and looking at these assets.
And so they want to buy well. I mean, like, if the story is not compelling, why am I going to do something? I've been waiting. I've got money. I'm not just going to go and buy something that sort of makes sense. It has to make good sense, or I need it for something. I need it for my business or whatever it is.
So, because obviously last year we saw so many of those first-time buyers kind of enter the commercial market for the first time, buying a lot of these smaller investments, be it those kind of set and forget type assets or like a small industrial or retail. Do you think that we could see some movement in some of those? There's people that probably bought, expensive and maybe not well located because we had the FOMO. People were just buying anything. It wasn't necessarily prime stock. It was kind of secondary or a bit higher risk or in regional locations. Could you see possibly a period where we see some of that stock come back into the market and these kind of more savvy investors snap it up? You seeing much of that?
Look, there's people who have paid a lot for things, and obviously, values have come back.
Yeah.
Like it's... I think where people don't have to sell, they're probably unlikely to, but where people have multiple assets and there's one which they're like, I need to sacrifice this one, they're probably better to do it sooner rather than later and just sort of cut and run. But, it is...
That was a tough question, I'm sorry.
No, it is, and look, we are seeing it, and it's a shame, and there's people who went too hard.
Yeah.
There's people who bought a lot of stock at very low yields. And I'm not quite sure where the exit is for them now.
Yeah. Well, we saw that with our volumes of transactions over the last year and part of the prior year where they really, did have a big spike up and that wasn't sustainable. And we're going to see that really come back now. But I think that's probably got us to the end of our discussion today. I hope everyone has enjoyed hearing about our thoughts on the commercial market, and thank you very much to Pete and to Steve.
Pleasure.
Really interesting time for the commercial market, and I think those economic indicators are one to really watch. I think inflation is super key, and if interest rates are able to keep inflationary pressure down, that's what we want to see. So if the RBA does go too soon, we're going to see that spike again in inflation, which will just see interest rates kind of continue to move upwards. So it'll be an interesting one to see. I think lots of lessons learned from prior kind of cycles. So hopefully that works out well. But thank you for everyone for joining in. There will be an email sent after this with a link that you can go ahead and watch or share that with your network. Last thing is we have another Between the Line Live event coming up on the 20th of September, and we'll be looking at the residential development market. These guys actually spoke a little bit about it today, but we'll deep dive into that a little bit more, also looking at new project sales. So I hope you can join us for that event next month. Thank you.